Japan's government is reportedly backing a Bank of Japan rate hike as early as September or October. Stick around until the end of this video to discover how this policy endorsement could reshape global financial markets, trigger currency interventions, and potentially dismantle the massive yen carry trade. For years, the Bank of Japan has kept an ultra-loose monetary policy, creating a significant interest rate gap with foreign central banks like the Federal Reserve. This gap has fueled global yen carry trades, dragging the Japanese yen to historic lows. However, as the yen continues to depreciate and domestic economic pressures mount, we're witnessing a crucial turning point in policy alignment between the government and the central bank, especially as US dollar to Japanese yen approaches 160. According to Bloomberg, the Japanese government now supports another BOJ rate hike as early as September or October. Prime Minister Takaichi is advocating for faster monetary tightening, pushing market expectations to a 74% chance of a September rate hike. At the same time, Japan's 2-year government bond yield has surged past the BOJ's official 1% interest rate to reach 1.65%. Meanwhile, the 10-year yield is nearing its high of 2.87%, indicating rising stress in the bond market. Reactions across Financial X have been swift. Market watchers note that with the yen hovering around 159.4 per dollar, the 160 level is the primary intervention threshold for the Ministry of Finance. Traders are closely monitoring the 74% probability of a September hike, emphasizing that a collapse of the yield gap could lead to rapid position liquidations. Prominent analyst Robin Brooks has pointed out that currency intervention alone cannot sustainably rescue the yen without a significant shift in BOJ policy. He stressed that the central bank needs to reduce its bond buying operations to allow long-term JGB yields to rise naturally. Financial experts agree that without curbing BOJ asset purchases, direct exchange rate interventions will only provide brief relief against ongoing yen weakness. A BOJ policy pivot could have far-reaching implications for Japanese equities and financial markets. Rising long-term JGB yields will directly affect corporate borrowing dynamics across various industries. While domestic financial institutions may experience structural margin shifts, export-heavy sectors could face challenges if rapid yen strengthening disrupts international competitiveness amid higher domestic interest rates. The potential narrowing of the interest rate differential between Japan and other economies could create widespread ripple effects. With the yen hovering near 159.4 per dollar, a rate hike paired with reduced JGB buying might accelerate the unwinding of low-yielding yen-funded carry trades, disrupting global risk asset markets. Individual investors should closely monitor central bank policy timelines and bond yield signals. Keeping an eye on key parameters like the 160 US dollar to Japanese yen intervention trigger level and rising 2-year JGB yields is crucial. Managing leverage and assessing currency exposure ahead of potential September monetary decisions is essential for risk mitigation. Based on market data, AI scenario analysis outlines 3 primary pathways. In the base scenario, the BOJ raises interest rates in September with government backing and reduces JGB purchases, leading to a strengthening US dollar to Japanese yen and orderly unwinding of carry trades. In a stress scenario, delayed BOJ action pushes US dollar to Japanese yen past 160, prompting aggressive Ministry of Finance intervention and increased JGB yield volatility. Lastly, in a broader market scenario, abrupt monetary tightening could trigger rapid liquidation of global yen carry positions, temporarily disturbing international risk asset valuations. In summary, first, government support makes a September BOJ rate hike increasingly likely. Second, 2-year bond yields at 1.65% reflect mounting pressure. And third, reducing JGB purchases is crucial for achieving lasting yen stabilization. If you found this video insightful, don't forget to subscribe for deep market insights, hit the like button, and share your outlook in the comments below.